Made more than $150,000 in 2025? Starting January 1st, 2026, just days ago, your catch-up contributions must be Roth. Not should be, not we recommend, must be, whether you want them or not. This is a brand new IRS rule, and if you're 50 or older and earned over that threshold, your entire retirement savings strategy just changed. And here's the kicker. Most people have no idea this is happening. Welcome to 50 cents of advice, dropping dimes of wisdom, 150 cent at a time. I'm Eli Pennywise, and today we're talking about one of the biggest changes to retirement savings in years, and it's coming whether you're ready or not. I've been navigating retirement rules since before Reply All became everyone's worst nightmare. And trust me, this new Roth rule is about as welcome as getting a Cabbage Patch Kid on Christmas morning in 1983, except the IRS doesn't care if you're on the waiting list or not. Let's break this down. Here's what we're covering. First, who this rule hits and why. Second, exactly how it changes your strategy. Third, what to do if your plan doesn't even offer a Roth option. And fourth, the workaround nobody's talking about. But first, let me tell you about someone who was just blindsided. Okay, so here's the deal. According to the IRS's final regulations issued in September 2025, if you're 50 or older by December 31st, and you earned more than $150K in FICA wages in 2025, your catch-up contributions in 2026 must go into a Roth account. Let me repeat that. It's not about what you will earn in 2026. It's about what you earned in 2025. So right now, you should be checking your 2025 W-2 when you get it in January. Now, what does this mean in real terms? A 2025 report from Charles Schwab shows that for 2026, if you're under 60, your catch-up contribution limit is $8,000. If you're between 60 and 63, it's $11,250. That's the super catch-up from Secure 2.0. That's extra money you can sock away. But here's the twist. If you cross that 150K line, every dollar of that catch-up has to be Roth, after tax, which means it's coming out of your paycheck after Uncle Sam already took his cut. Think of it like this. Back in the day, you could choose between ordering at Wendy's Super Bar and building your own meal exactly how you wanted it, or just taking the combo meal. Now, if you're in this income bracket, the IRS is handing you the combo meal and walking away. No substitutions. Let me give you a real example. Say you're 55 years old. You made $175,000 in 2025. You want to max out your catch-up in 2026? That's $8,000. Under the old rules, you could put that $8,000 in your regular 401k pre-tax, which means you'd save about $2,000 in federal taxes right now if you're in the 25% bracket. Your paycheck would feel $6,000 lighter instead of $8,000 lighter. But now, that full $8,000 comes out after tax. Your paycheck takes the full $8,000 hit. No immediate tax break. It grows tax-free, sure, and you won't pay taxes when you withdraw it in retirement. But today, it stings more. But here's where it gets interesting and controversial. Now, your employer won't tell you this. Your 401k provider probably buried it in a 2-page PDF you'll never read. But this rule was supposed to start in 2024. The IRS pushed it back twice because companies weren't ready. And get this, according to a 2024 study from Vanguard, nearly 40% of employers still don't offer a Roth 401k option at all. So what happens if you're required to make Roth catch-ups but your plan doesn't have a Roth option? Great question. We'll get to that. But first, let's talk about why this rule exists in the first place. Because it's not about helping you retire. Alright, here's the thing Wall Street doesn't want you to know. This isn't about your retirement. It's about the government's cash flow. When you put money into a traditional 401k, the IRS loses tax revenue today. They get it later when you withdraw. But Congress needs money now. It's like when your buddy owed you $20 from that Def Leppard concert in '87 and kept saying, "I'll pay you back later, man." Except now the government decided they want their money up front, and they're not taking IOUs. According to the Treasury Department's own estimates from their 2025 final regulations, this rule will generate billions in additional tax revenue over the next decade. Not because you're paying more in total taxes, but because they're collecting sooner. Now, does that mean Roth is bad? Not necessarily. For many people, Roth contributions are a smart move. You pay taxes now at today's rates, and if tax rates go up in the future, which, let's be honest, they probably will, you win. But here's the key. It should be your choice. And for high earners, that choice just got taken away. Hang tight, because there is a way around this if your employer doesn't offer Roth, and it's actually pretty clever. But first, you need to understand the Paycheck Impact, because this is where people get surprised. Let's talk about what this actually means for your monthly budget, because the math matters. If you're making Roth contributions, you're paying taxes on that money up front. That means your paycheck gets smaller. A lot of people underestimate this shock. Let's say you're contributing $2,000 per month as a catch-up in 2026. That's about $667 per paycheck if you're paid twice a month. Under the old system with pre-tax contributions, your paycheck would drop by maybe $500 after tax savings. Under the new Roth requirement, your paycheck drops by the full $667. That's about $160 more per paycheck. Times 24 paychecks a year, that's nearly $4,000 less in your pocket annually. Now you might be thinking, okay, but it's worth it because it grows tax-free, right? Sure, in theory, but only if you can afford the hit to your paycheck today. According to a 2024 report from the Federal Reserve, the median household in their 50s has less than $10,000 in emergency savings. So let me put this in perspective. If taking home $4,000 less per year means you're living paycheck to paycheck or racking up credit card debt, that tax-free growth isn't worth squat. It's like trading your G.I. Joe with the Kung Fu grip for a handful of garbage pail kids. Sure, they might be worth something someday, but right now you need lunch money, and your mom's gonna be pissed. Here's a real scenario. You're 58, making $160,000. You want to retire at 65. You plan to put $8,000 a year into catch-up contributions. Over 7 years, that's $56,000 contributed. If it grows at 7% annually, you'll have about $73,000 by retirement. Tax-free withdrawals in retirement? Great. But if that extra $4,000 per year in take-home reduction means you're putting $4,000 on a credit card at 22% APR, you're losing more in interest than you're gaining in tax-free growth. Which brings me to the big question. What if your employer doesn't offer a Roth 401k? Because remember, 40% of plans don't. So what then? Okay, here's what you need to know. If your employer plan doesn't offer a Roth 401k, you've got 3 main options. Option 1, Roth IRA contributions. You can contribute to a Roth IRA instead, but there's a catch. For 2026, the Roth IRA contribution limit is $7,500, plus a $1,100 catch-up if you're 50 or older. That's $8,600 total. But, and this is a big but, there are income limits. If you're single and make more than $165,000, you can't contribute directly to a Roth IRA. If you're married, filing jointly, and make more than $246,000, same deal. For many high earners affected by this new rule, Roth IRAs aren't even an option. Option 2, the backdoor Roth conversion. This is the workaround high earners use. You make an after-tax contribution to a traditional IRA, no income limits there, and then immediately convert it to a Roth IRA. Sounds great, right? But there's a trap called the pro-rata rule. And let me tell you, understanding the pro-rata rule is about as straightforward as assembling a Sears bicycle on Christmas Eve, with instructions that look like they were translated from Swedish to Japanese to English. Good luck. Here's what happens. If you have any pre-tax IRA money sitting around, old rollovers, traditional IRAs from past jobs, the IRS makes you count all of it when calculating taxes on the conversion. Let's say you put $7,500 into a non-deductible traditional IRA and try to convert it. But you also have $92,500 in a rollover IRA from an old job. The IRS sees $100,000 total. Your conversion is only 7.5% after tax money, so 92.5% of your conversion is taxable. You just triggered a hefty tax bill. Option 3. Just don't make catch-up contributions. Yeah, I know, not ideal. But hear me out. If your plan doesn't offer Roth, if you're over the Roth IRA income limits, and if the backdoor Roth is too complicated or costly, you could just not max out your catch-up. You can still contribute up to the $24,500 standard limit for 2026 on a pre-tax basis. You just can't add the extra $8,000 catch-up. Is it leaving money on the table? Sure. But if the alternative is a tax nightmare or a hit to your cash flow you can't afford, sometimes the smart move is to walk away from the opportunity. So to recap, if you earned more than $150K in 2025 and you're 50 plus, your 2026 catch-ups go to Roth, whether you like it or not. If your plan doesn't offer Roth, you've got options, but they're all messy. All right, here's what you came for. What do you actually do about this? Step 1. Check your 2025 W-2. When you get your W-2 in January 2026, look at box 3. That's your FICA wages. If it's over $150K, you're subject to this rule. Step 2. Contact your plan administrator. Call HR or your 401k provider, Fidelity, Vanguard, whoever, and ask 2 questions. Does our plan offer a Roth 401k option? How do I designate my 2026 catch-up contributions as Roth? Some plans will make this automatic. Others require you to fill out a form. Don't assume it'll just happen. Step 3. Run the numbers. Talk to your accountant or use a tax calculator to figure out how much this will actually cost you in take-home pay. If you can't afford the reduction, scale back your contributions or skip the catch-up entirely. Don't go into debt to max out a retirement account. And here's the thing nobody wants to say out loud. If this rule doesn't work for your situation, you don't have to play. Yeah, you might leave some catch-up contribution room on the table. But if forcing Roth contributions means financial stress today, it's not worth it. Retirement savings only work if you can afford to save. Look, here's what nobody wants to say out loud. The IRS doesn't care about your personal situation. They've got revenue targets, and they're gonna hit them. That's what this rule is really about. You've got choices. Maybe not the choices you want, but choices nonetheless. And that's what matters. Knowing your options and picking the one that actually works for your life, not some generic financial plan. So here's what we covered today. 1. If you earned $150K plus in 2025 and you're 50 or older, your 2026 catch-ups are Roth only. 2. This hits your paycheck harder because you pay taxes up front. 3. If your plan doesn't offer Roth, you've got workarounds, but they're complicated. 4. It's okay to skip the catch-up if the math doesn't work for you. If you found this helpful, hit that subscribe button. I post new retirement strategies every week. Remember, your retirement, your rules, even when the IRS tries to change them. I'm Eli Pennywise, and that's your 50 cents of advice. Keep the change.